call, let him know. Did you switch it to PG? Welcome. Ça va? Okay, you're gonna switch to laptop right now. You see an echo if you getting something, the signal. It's not showing on the projector.
Hold on. That's not plugged in. Yeah.
Okay.
Give it a couple seconds. All right, good. There you go.
Okay.
Check 1, 2. Couple seconds.
You can refresh also.
Nothing? What about an ice bar?
Take a few seconds. Hmm? It's still black, right? Okay. Hmm. Yeah. Same issue there. And if we're not using the HDMI right now, we're using the.
So check this out.
Okay.
Hold on, okay?
Okay, hold on a second. You wanna lower the resolution? Okay, try. Lower the resolution. Arrangement. Go to arrangement. Okay. Standard, yeah. No.
Scaled.
Yeah. And then choose the less. Yeah. Go ADF. Like that. Okay.
Tell me, give it a couple seconds.
Give it a couple seconds and then refresh. Refresh the window.
So then it is DHCP then. How do I reboot that? Because if someone hit Blu-ray, how do you go back?
Just reboot the rack.
I don't have time for that.
I don't have time for that.
I'm gonna take it off.
Yeah. It's teaching you how long it was gonna be teaching? Now?
About 5 minutes.
Okay, you know what?
Leave it, I'll
we
take
gotta
it.
talk to him. Let me reboot it. I'll talk to him.
All right.
Otherwise we lose his
I'll mute it from here. No? In the floor box? Here. Hello, Professor. How you doing? Doing well.
Everything works?
Yeah, Mom Clooney was here earlier, so we had to set up her classroom.
Oh,
So you're gonna have to bear with me. Let me take this stuff away. Do you use your laptop or you use the actual PC here?
I'm going to use the PC today.
Okay.
You use the PC?
Yeah.
Oh, that's perfect.
Good. Great. Anything else I can do for you today?
That's all. Thank you.
Have a good one.
You too.
Have a good one.
Thank you. Wow, it's quiet. You know, the quiet. Hang on. The quiet is like self-reinforcing because now anyone who talks is heard by everyone. So now no one will talk. All right. Let's see if this works. Okay. Good morning. All right. Did everyone have a nice weekend? Yeah? No? Maybe? 50% chance you had a nice weekend. Good morning. All right. All right. Couple announcements. So today, I have to leave right after at 12 o'clock. Apologies for those who would like to chat. I have to fly to Boston, present a paper, fly back, all in 12 hours. So, so I can't stay today. Tomorrow, we're going to end a little early because we have here at Columbia Data Science Day. You're all invited and welcome to come. I think you have to register or buy a ticket, but I think they're very cheap for students. We're going to have a sort of day. It actually begins during our class, but afterwards there's a session I'm going to be speaking at, and then followed by a session with President Bollinger, sort of all about sort of initiatives at Columbia, research, sort of activities in the general area of data science, which is very exciting, crosses disciplinary boundaries, and you are all welcome to come. So I'm going to be, we'll be wrapping up maybe at 11:45 tomorrow. So that I can get over there. On Thursday, I sent out an email. We have an event here that I strongly recommend everyone come to. It's Securities Markets Issues for the 21st Century. I just learned that you need to RSVP to come to this event in the Drapkin Lounge. We're going to have former SEC Commissioner Gallagher and current SEC Commissioner Jackson. Professor Coffey will be there. It's just going to be a great event, and I strongly recommend that you come at 4:30 on Thursday. But in order to come, you need to RSVP so you can speak with, let's see, who's running this? With Laura Merritt, Fox's assistant, and I'm trying to remember Laura's last name. What? Miller, thank you, Laura Miller. So go talk to Laura about registration. We might send out a link to the class so that everyone can register. Okay, what are we doing today? So today we are going to start insider trading. And specifically today we are going to make a transition away from the 1933 Act and towards the 1934 Act. Pretty much for the rest of the course, we're going to be focusing on the 1934 Act. I wanted to bring up the text, let's see. And I was going to do this assuming you were going to keep talking, and then you all got quiet. So, all right. So here we go. So now this. The backdrop of silence. So let's just look at this text of 10b. Maybe we'll try this. There we go. Okay. So this is really going to be the starting point for, like I said, the rest of the course. It shall be unlawful. I just forgot. Administrative matter, last one, office hours. Tomorrow, I'll be hosting office hours after this data science event, so from like 1:30 to 3:30. So if you want to come by, something like that, just come by. Sorry. Okay. Section 10. It shall be unlawful for any person, directly or indirectly, by the use of any means or instrumentality of interstate commerce or of the mails, or of any facility of any national securities exchange, and we're going to focus on B, which is to use or employ in connection with the purchase or sale of any security registered on a national security exchange, or any security not so registered, or any securities-based swap agreement, any manipulative or deceptive device or contrivance in contravention of such rules and regulations as the Commission may prescribe as necessary or appropriate in the public interest or for the protection of investors. All right, so Section 10b prohibits what? Any manipulative or deceptive device or contrivance in contravention of the rules that the Commission may prescribe. And of course, you know, having looked at this in the book, but let's just look at 10b-5. We know that the SEC promulgated such a rule. It shall be unlawful, Rule B5, 10b-5 tells us, for any person, directly or indirectly, by use of any means or instrumentality of interstate commerce, or of the mails, or of any facility, or of any national securities exchange, A, to employ any device, scheme, or artifice to defraud, B, to make any untrue statement of a material fact or to omit to state a material fact necessary in order to make the statements made in light of the circumstances under which they were made, not misleading, let's make that a little bigger, to engage in any act, practice, or course of business which operates or would operate as a fraud or deceit upon any person in connection with the purchase or sale of any security. Okay. So what we're going to do this week, at least, is sort of break down the substantive elements of insider trading liability, and we're going to just sort of take them element by element. So what's the first element? The first element is that there needs to be some untrue statement. I'm going to focus on subsection B, although we will also talk about A and C. But let's start with the most common basis for 10b-5 liability, which is to make any untrue statement of a material fact or omission. In other words, a material misstatement or omission. Now, this is going to sound a lot like our conversation of what part of the 1933 Act. Where have we seen this sort of language before? Does anyone remember? Does anyone remember where we saw this kind of language about untrue statements of a material fact? Yeah? Right? Yeah. Yeah. So where in the 33? Well, let's just look. I don't know. Let's just see what we can find. Wikipedia. Could do that. Section 11, yeah, Section 11, yeah, that's right. Yeah, all right, let's look and see. Okay, in case any part of the registration statement when some part became effective contained an untrue statement of a material fact or omitted to state a material fact required to be stated therein or necessary to make the statements therein not misleading, each person may sue. All right, so we've seen this language before in Section 11. We saw it in another place, in Section 17. All right, so we've seen this language, and this is sort of the classic language prohibiting or referring to misstatements or omissions that give rise to potential liability. Here, it's a particular kind of liability. It is fraud liability. So let's talk. We're going to kind of break this down step by step in the casebook beginning on page 1039. There is sort of a systematic overview of Rule 10b-5. First of all, there's an implied private cause of action. You know that. So we will not spend too much time this week on the procedure. We'll talk more about procedural aspects next week. But bear in mind that if you're bringing a 10b-5 lawsuit, you're bringing it as one who purchased or sold a security and claiming that your purchase or sale was sort of induced by some kind of fraud. So while in the Section 11 setting we have in front of us a registration statement, and the claim is that the company was able to sell its securities at a price that was artificially inflated or deflated, I guess you could say, if it's going the other way. Here, we are talking about secondary market trading. So in the setting of secondary market trading, we're going to be thinking about secondary market transactions, and thus the injured, so to speak, are often those who bought or sold securities and the money did not make its way to the corporation. So these are secondary market lawsuits often, not always, but often. So the key in sort of understanding what is a misstatement or omission, the starting point is the discussion in Santa Fe Industries v. Green. So who would like to tell us what happened in Santa Fe Industries v. Green? Yes, this is why next year, complete randomization, every class and no laptops is coming to your SecReg colleagues. Yeah, but for now you can enjoy the fact that I was too nice the first time. All right, what happened in Santa Fe? Yes. Lisa.
There was an appraisal, and that's like way lower than the actual, well, like the petitioners, the plaintiffs say that it's way lower than what the actual value is of the stock.
Yeah. So Santa Fe Industries, we had what? We had an acquisition. As everyone now, everyone's either taken corporations or concurrently taking it. Have we all done freeze-out mergers? All right. So you can acquire on the open market or via sort of block purchases, right, a large amount of stock, something like 90% for Delaware corporations, right? And then you can effectuate this so-called short-form merger, where you basically say, hey, you know, I'm going to give you a particular price, and too bad, so sad if you don't like it, because I own 90% of the company, which means that I'm the boss anyway, and you should just, you know, complain if you want to complain, but I own 90%, and so all that is needed to effectuate this merger is my own consent to my own offer, and thus, that's the price you're going to get. So as you know from corporate law, that's a little concerning, so we have this appraisal remedy. All right. So the issue here is that the stock is valued by valued at by Morgan Stanley. The minority stock is valued by Morgan Stanley at what price? What's that? Lisa, do you have it? $125. And the what's the consideration that's offered to the minority shareholders? Yeah, $150. So that sounds like a good deal, right? I mean, if you're going to complain as a minority shareholder, then the response is, look, you're getting 25 a share more. Why were they unhappy, though? Why were these minority shareholders nonetheless unhappy if they were getting $25 a share premium over the Morgan Stanley price, Isabel? So did anyone like go back and figure out how that could be? I didn't. That shocked me. How could the company be worth a quarter of its, well, more than a quarter, less than a quarter, of its physical assets? I don't know. That's weird. Weird, right? All right. So the challenge here is that you have supposedly an inadequate price, and instead of pursuing an appraisal, let me ask you, did they pursue an appraisal remedy? Do you know, Isabella? They did not. Why not? Why did they not pursue an appraisal remedy? Well, yeah, Lisa.
I think they can potentially get more damages by suing under 10b-5.
They definitely wanted the higher damages. I think one problem they might have is that the claim here is not that the shares are valued at over $700, $772, whatever the number is, but that the physical assets are. And the claim that the physical assets are valued at that amount amounts to a claim about the underlying informational environment of the firm, as opposed to a claim as to regarding the value of their shares. Does everyone see why that's the case? So the claim here is not our shares are actually worth $800 a share. The claim is the most evidence we have is that the shares are worth $150. But what we weren't told is that there's a Mercedes-Benz sitting in the garage, and the Mercedes-Benz makes the company worth, or I don't know, a Learjet or something. And the Learjet in the garage makes the company worth 772 or whatever it is, right? In other words, it's a claim not as to an incorrect valuation by Morgan Stanley, who are sort of qualified financial advisors, but a claim as to the book value of assets or just the value of the firm's assets not having been disclosed. That is sort of the way they're, if you will, framing this problem. Has anyone taken accounting? Can anyone tell me why it is, if does anyone have an idea, that a company with a Learjet sitting in the garage or just very, very valuable assets, why it might be that a reputable financial firm like Morgan Stanley would reach a valuation on the order of 20% or less? Yes. Tell me, are you David? No. Joshua. Okay, my CD charters. Next year, we're all doing name tags, too. So so many mistakes. Okay, so right. So it could be leveraged assets, but that should affect the equity valuation, right? So if you think about assets equals, so think about the accounting equation. For those who haven't taken accounting, basically, the sum total of a firm's assets is going to be equal to its liabilities plus its equity value plus its net worth. So if you lever up the firm, that is, you increase its liabilities, you can also increase its assets. But then the equity valuation shouldn't change. Yes? Could be an off-balance sheet lease, but that should still make the equity value. I mean, maybe I'm not fully, yeah. Well, it says based on the fair market value of the physical assets. So this is a valuation, 772 is a share, based on the market value of the assets, right? So it's a puzzle. All right, anyone else? Any ideas? Yeah. Josh. Yeah. Well, that great. That should go the other way, right? So that if you're acquiring, I think, I mean, this isn't a liquidation. So you're saying, I think you're saying, okay, so if the assets are theoretically worth $800 or something, but you have to sell them, they would be worth a fraction of that. But is there any evidence that they would be sold in a fire sale? Yeah.
Is it possible that they just couldn't be sold? Is some type of asset that, for whatever reason, maybe they had a 50-year lease on the Brooklyn Bridge, but they couldn't transfer it? Or
but it has a market value, right? So, okay, I think you're getting closer. Felix, right? I think Felix is getting closer. Yeah. Yeah, okay. So there could be a disagreement over valuation, but I think possibly the more, but then you would run to the appraisal remedy. I mean, there's a huge delta there, right? So you can make, I mean, there's got to be something, yeah.
Might be that the value of the company operation is significantly less.
Right, that's right. So I think that's the right direction, right? So there's this sort of Q theory of investment some of you might be familiar with, which basically says that when we take physical assets and we transform them into revenue-generating, when we try to generate revenue from physical assets, we don't always generate revenue in such a way that the value of the assets is equal to the value of the firm from the standpoint of the cash flows of the firm that result from the deploying those assets in this business. Okay, so imagine, just to give you that's a little abstract, let's work through an example. Suppose you have a really, 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 really expensive machine that you bought, like a Learjet. Let's take that example. So there's a Learjet that's sitting on the balance sheet of the company. The problem is, it turns out that pilots are really in short supply. And so you can't find a pilot to fly the Learjet. Why would you need a pilot? Well, maybe you think about the company. The company is a private jet company. And so for this business application, you actually need pilots, not only Learjets, right? And so the mere presence of physical capital that could be very, very valuable does not imply that a business that's, may have a contract, let's say, for private. In fact, it could be that you have a commitment, to fly some company's executives, but you can't find a pilot, in which case the value of that Learjet to the business might be very, very low. So this kind of Q theory of investment says that basically if we have assets, there's always when those assets are sort of deployed, there's always a productivity loss, and there's adjustment costs when we try to take those assets and turn them in to cash flow, to a stream of cash flows. And so if you've ever heard, has anyone ever heard of Tobin's Q? Yeah? Nod your heads, no? Okay, so Tobin's Q, for those who have never heard of it, is basically just the ratio. Think of it like a fraction. Okay, it's literally, on the top, the market value of a firm, and on the bottom, its book value. That is the value of its assets. Actually, let me correct that. The market value of the firm's equity to the value of its physical assets. All right? And for purposes of our conversation, let's just think of that as the market value of those assets. So in this case, for this company, Tobin's Q is very small because it has something like $150 a share in equity value over $772 a share, let's say, the fair market value of its assets. And the reason, sort of in the Q theory of investment, that you would have a small Tobin's Q is because you have a really hard time, there's something wrong with your ability to convert your physical assets to productive uses that generate cash flows. Okay, and so for that reason, there's a loss. Now, that would imply that if you could just liquidate those assets, suppose, I agree with the fire sale critique, but suppose that you were able to liquidate them at something closer to 772, then the value that could be, really just think of it like the socially efficient choice for this firm is to be liquidated. Meaning if the social planner, if the all-knowing sort of wise social planner could look at the firm and say, well, you have these assets that basically are not being put to productive use in this firm, what I prefer to do is just liquidate the firm, sell off the assets, and compensate the shareholders in cash. And in effect, the minority shareholders are claiming that an inefficient choice was made here, right? That instead of liquidating these assets, or another way to think about it is sort of this 150 valuation was used so that the majority shareholder could expropriate the liquidation value of those assets. Or not even liquidation. It could be, for example, that those assets are useful to another business that the majority shareholder has. It doesn't really matter. There's sort of different ways you can think about efficiencies in an M&A setting, but at the end of the day, the claim is we should have been just as entitled to that 772 liquidation value, because if you had actually just liquidated the firm, we would be getting 772 a share. And because you've effectuated this merger where you've actually, let's suppose, completely accurately characterized the equity value at 150, that allows you to just shift the value of the firm's unproductive assets away from us and into your hands. Does everyone see this? Is this clear? Any questions on this? Does this make sense? Davia?
Okay. I'm sorry. So basically the value of these assets, because they're not, okay, so while they might have a high market value, I guess the company wouldn't be considering this high market value because it's not actually helping them to produce, I guess, what the business is out to produce?
Yeah, exactly.
Okay.
Now, we don't know, I mean, unless you read the opinion or sort of dug into this, I don't know why Morgan Stanley, so we see at the top of 1045, Kirby's physical assets were appraised at something like $640 each for each of the 500,000 shares. The stock was valued by Morgan Stanley at $125 per share. So So yeah, so when you first read that, it could sound like this is just a highly leveraged company, but I don't believe that's right, because the following paragraph says the amended complaint asserted that based on the fair market value of Kirby's physical assets, Kirby's stock was worth at least $7.72 a share. So the first time you read it, I can see why you would think, okay, it's like a levered company. Basically, this is just the value of the assets, not the value of the equity. But the following paragraph makes clear they're not happy because they argue their stock was actually worth $7.72, which precludes the levered interpretation, and it suggests that what we have here is a gap between the market value of the assets and the market value of those assets deployed in production, right? Whatever this firm was doing. Does everyone see that? Everyone? Okay. So the question is that non-disclosure, okay, the non-disclosure of the 772, well, let me put it differently, actually. There isn't a non-disclosure problem here. The question is the mere fact that the 772 is so much higher than the 150. Is that in and of itself a basis for 10b-5 liability? So there was not a non-disclosure problem. This is a key point, right? You see that the court points out on 1046 that minority shareholders were given all relevant information on which to base their decision, and we're told that the appraisal did convey the valuation of those shares in the appraisal. So there's an important distinction between, these minority shareholders were not given some fact that they needed. It's clearly not the case here, right? They're clearly told this is what the assets are worth, and in our view, the firm's fair value is 150. If they had been given some information that was misleading or that contained an important omission as to the actual value of those assets, then their claim would be, it's not that the valuation was unfair, it's that we were lied to. But what the court points out is that there is no such fact in this case. That in this case, they were given all information, both regarding the value of the assets and the value of the shares, and they could decide, based on that information, whether or not to accept the offer. So if they're unhappy with the 150 number, what they should have done was gone to what? To the appraisal remedy and said, look, it's wrong to value the firm based on its cash flow from production or whatever method Morgan Stanley was using. Instead, the right valuation approach should be based on the physical assets. The problem is that they're not doing that, right? They're making a claim under securities law that sounds in insufficient disclosure or misstatements or omissions. And the court's argument is, look, there is no misstatement or omission here, right? And that's the key point. That if you're unhappy with the terms of the merger, you should resort to state corporate law. Securities law, 10b-5, is restricted to those cases where there is, in fact, some fact missing or some misleading statement that causes shareholders to make incorrect decisions, not a disagreement over the interpretation of publicly available information. That's the key takeaway. Does everyone see that? So really, the key thing you need to realize from Santa Fe v. Green is that it's not, we're going to use 10b-5 in a focused manner. We're going to restrict sort of the federalization of disputes between investors and firms, and between investors and other investors. We're going to restrict that to cases where we can identify some sort of insufficient disclosure or some kind of misleading behavior that centers on trading in markets, statements, and so forth, but we're not going to let 10b-5 federalize any and all state corporate law claims. And the key dividing line between the two is going to be this question around how much information was presented to shareholders. And so here, the key idea is that while there might be a disagreement over the valuation method. There is not a disagreement over the facts that were the input, so to speak, to that valuation method. That was clearly disclosed fully to shareholders at the outset, to the minority shareholders at the outset. Does everyone understand this? It might seem trivial, but it's important to take this one step at a time. So we see that this Goldberg v. Meridor case, the casebook tells us, Judge Friendly distinguishes Green on that basis, and that was a case that involved some non-disclosure of information. He's saying, look, Green is just basically saying that if all material facts of the transaction are disclosed, you can't federalize Delaware corporate law claims via 10b-5, but that doesn't mean that you can't bring suit for misstatements or omissions. All right, so what happened in Wharf Holdings? So Wharf Holdings is a little squib case here that's mentioned. What happened in Wharf Holdings? What was the holding in Wharf Holdings? So Wharf Holdings was this sort of brief discussion in 1050, 1051, 1052. What's the bottom line from Wharf Holdings? What do we learn from Wharf Holdings? Yeah, Ben?
That the deception element of 10b-5 can be satisfied when a promiser secretly intends not to honor a promise when he makes the promise?
Right. More than the deception element. So there's, so that's right, the deception element. So deception can be thought of in two different ways, right? So there is deception in the sense of a misstatement or omission, which is what we're talking about right now, and then there's like deceptive intent, right? So let's sort of talk about each of these separately. So the holding so Wharf Holdings involves a case where the company, there's actually written evidence that the company is misleading, and they have this internal memo where they say, our next move should be to claim that our directors got quite upset over these representations, but publicly we're not going to acknowledge. In other words, in this memo, they're sort of saying, yeah, basically we're going to lie. Okay. Now, the point from Wharf Holdings is that these sorts of misrepresentations can be satisfied if you have subjective evidence of a difference between what the firm actually thinks and what it's telling the world. So, yeah, deception, that's right. Deception of a very particular kind, an easy case, a case where you have where you're subjectively misleading the market in the sense that there's evidence that you knew something was true and you told the market otherwise. Now, those are going to be few and far between. It's hard to find evidence of a company affirmatively misleading the market, affirmatively misleading investors. We'll come back to this question when we do fraud on the market towards the end of the semester. But the starting point to realize is that the easiest misstatement or omission to establish is the one where you have evidence that of lying, right? Evidence that you're telling a falsehood deliberately. Now, it gets a little more tricky when, as in typical transactions, you don't have that kind of evidence, and what you're trying to do is apply a very generic anti-fraud standard to behavior that falls outside the sort of typical lying misrepresentation cases that constitute fraud. So one way to think about 10b-5, and this is really going to characterize the evolution of the doctrine into insider trading, is that you start by seeing these easy cases where a company sort of knows something to be true and lies about it, a fact to the market. And then as you try to think, okay, well, what are the other ways that fraud can manifest to investors, that fraud can play out, you start to think of more and more sort of difficult cases. And we'll see in the evolution of insider trading law is basically a story of a fraud standard that originally applied to lying, right, to simply telling a falsehood, evolved all the way to trading while not disclosing that you know something. And so 10b-5 kind of grows and grows and grows, and the big story of 10b-5 is the points at which the Supreme Court in particular starts to cut back on the ever-growing reach of anti-fraud liability, because at the end of the day, the defense to fraud is always that there was some sort of affirmative disclosure. And so the casebook talks in 1052 that you can always mount a defense along the lines of due diligence, right? So remember in section 11 we talked about how in this this negligence standard that applies to underwriters, and underwriters can have a due diligence defense where they say, look, we checked everything out. Well, similarly here, the defendant can say, look, you might be, in fact, accusing me of misleading, but you should have checked out the facts. You should have gone and done some due diligence. And in fact, your sort of complete disregard for your lack of caring about the veracity of what I'm saying, the fact that you just clearly did not employ any effort to try and uncover the truth, if that is sufficiently severe, in other words, if I'm kind of making a mistake and you are just willfully closing your eyes, we're going to continue to reason under this fraud theory that I'll be off the hook. The extreme example of that is the so-called big boy letter, which the book talks about in this section 4. Has anyone heard of did you guys do big boy letters when you were practicing? So here, kind of take this fraud sort of theory to its limit, where you agree, plaintiff and defendant, the two parties agree, firm and investor, that the investor is not relying on anything that the firm is saying. And so if you specifically disclaim reliance, so the theory goes, you can't be liable for fraud. And in fact, that is the law, right? So in Rissman v. Rissman, Judge Easterbrook basically says, look, if there's an anti-reliance clause, it's kind of the extreme evolution of fraud theory, which is I am going to specifically, we're going to agree that I cannot be misled by anything you say. I am not going to rely on any statement you make, then you definitely can't have a fraud claim. Now that might seem trivial, but realize that it's delineating a particular scope of this doctrine that's squarely centered on fraud, okay, on misleading statements. So we start with a subjective standard. We talk about how there might be an evaluation of whether or not there was this sort of plaintiff's due diligence or this plaintiff's contributory negligence. And the extreme case of this fraud paradigm is, in fact, the big boy letter, where you're going to be disclaiming, you're going to be agreeing that there cannot be fraud. I want you to see how these are all contributing to a fraud-based story of 10b-5 that is going to be sort of completely left aside, by and large, when we get to insider trading. Okay, so the way we traditionally thought about 10b-5 before insider trading was about dealing with the equivalent of common law fraud. And where's Kate? Sent me this very cool discussion of common law fraud, and so sort of saying, it could be that you think about common law fraud and how common law fraud has informed 10b, the evolution of 10b, and I think that that's a really neat idea. When we get to insider trading, we see that that sort of all goes out the window. All right, so the discussion thus far is to kind of center you in thinking about 10b-5 as an anti-fraud statute. Remember the duty to update and the duty correct. Same logic. There's some fact that you know that has changed that you haven't told the market about, and so we're going to ask what's the right boundary for imposing a duty to update or correct. And the answer is going to be turn on some kind of sense of what investors should have known or what the court thinks should have known. Again, all of this is about information in transactions. That will serve as the basis for insider trading liability, but in a very different context. Is this clear to everyone? So in a way, this kind of preface to insider trading liability is just to get you thinking about 10b and its historical anti-fraud framework. And then comes Katie Roberts, right? So not chronologically, it's a pretty old case, 1961. What happened in Katie Roberts? And what's interesting about Katie Roberts is how far we start to move away from this classical fraud paradigm. What happened in Katie Roberts? What happened in Katie Roberts? Yes. Candace. Oh, yeah. How's that better? What happened in Katie Roberts? Yeah.
It's basically an insider trading case. So you have a partner at this firm purchase a lot of stock, and the price of the stock goes up, and then he receives information that dividends are going to be cut, and he sells the stock.
Yeah. So let's just kind of break this down a little bit more. So we have Curtiss Wright, famous corporation in the 1950s. Remember, there's a con law case on Curtiss Wright. Yeah, let's bring back memories. All right. So Curtiss Wright invites a bunch of folks to an event, right? So there's this event unveiling a new type of internal combustion engine. All right. So people are pretty excited about Curtiss Wright over the period November 23rd to November 25th. Now, what happens, you said, on the morning of November 25th? There is a sale, right? You mentioned that, but what's the exact story? Does anyone remember sort of how the movie unfolds on the morning of November 25th? Yeah.
So I thought there's a board meeting.
Yep.
And they decide to cut dividends.
Yeah.
One of the board members then contacts the person who's trading on the stock, and he puts a sell order in before the dividends are announced. The stock goes down, and
yeah. All right. Before that, so let's just start with the board meeting. So the board is meeting in the morning. Probably, I don't know if we're told when exactly they started the meeting. I think they started around 9 or so, 10 or so, but it's not given. At some point in this morning meeting, so the market had expected, well, the prior dividends were 62.5 cents per share for each of the first 3 quarters of 59. Then the board decides that morning to approve a dividend at 37.5 cents per share, right? So something on the order of half. And so the decision is taken sometime before 11 o'clock. But what happens at 11 o'clock? Yes, Isabel.
So the board authorizes the transmission of this information that they're cutting the dividend?
Great. So one step at a time. So at 11 o'clock, the board authorizes transmission of the decision by telegram to the New York Stock Exchange, the decision to cut the dividends. Now, did the information reach the New York Stock Exchange or reach the public at 11 o'clock? No.
It did not.
What time?
There was some sort of telegram typo, so it didn't reach them until 11:48.
Okay, so there was a telegram typo. The telegram was transmitted at 11:12, but it wasn't delivered to the exchange until 12:29. But it was given to the Wall Street Journal at 11:45, and you're right, published on the Dow Jones ticker tape at 11:48. Okay, now what time did? So we have this sort of story, right? We have this setting. Imagine there's a decision at 11 o'clock. Here's his director, Mr. Cowden, and what does he do? Well, there's a recess of the meeting. It must have happened shortly after 11, right? So you can imagine they make the decision, we're going to cut the dividend in half, and Mr. Cowden sort of steps outside the meeting, right? And he goes to the payphone or goes to his office phone, and he calls up his friend, Mr. Gintel, and he says to Mr. Gintel, we've cut the dividend, right? You should sell your stock, right? And these are like insider trading stories, right? And so Mr. Gintel sells a lot of shares, 2,000 for 10 accounts, 5,000 for 11 accounts. He actually short sells a bunch of accounts. What time, Isabel, were those orders executed?
Sometime between 11:15 and 11:18.
Okay. So here's my first question for you in this case. Were those trades made on material let's suppose the information material. Were those trades made on non-public information? What do you think? I mean, the case says they were, but do you find that persuasive?
Well, there's an argument that can be made that they should have been public, right? Because the telegram error was kind of a weird, instance, and it was a coincidence that it wasn't public information at that time.
Yeah, that's fact number one. That's kind of bizarre about Katie Roberts. It was all driven by a telegram error. Now, do we think that Mr. Cowden knew about the telegram error?
I don't think so. I don't think there's any.
I don't think he did either. I mean, we don't know for sure, but I think that the guy steps out of the meeting, goes over to his office, makes a call. What if he was just thinking that when the board authorizes the transmission of information via telegram, it's really only going to take a few minutes. And so by the time he tells his friend, Mr. Gintel, the information is public. Is that plausible? I mean, could he have thought that? I mean, you seem to agree that he could have. Yeah. Anyone disagree, Felix?
I mean, if the information was public and had been fully absorbed by the market, there'd be no benefit to trading on it.
Good. Felix has jumped ahead 20 minutes, but we might as well think about this. So one of the issues that's going to keep coming up in these cases is exactly this point, which is what it means for information to be public. And the challenge here is that there's kind of a deep circularity. In this case illustrates it. Later cases we're going to look at are going to illustrate it. So keep this one firmly in your heads, because it's really important. If the information, what does it mean for information to be public? Well, later on we're going to read a definition of public information that's something to do with information being available to investors. But ask yourself, was Mr. Gintel supposed to look at the Dow Jones ticker tape and only trade after there was an announcement? Is that what the court is kind of saying? Is that what we mean by public information? Or do we mean sort of like the mailbox rule, right? As soon as it's transmitted, it's public. And this is where Isabella and I were going, which is well, maybe if it's transmitted, it's public. And Felix makes a really good point, which is suppose you accepted the idea that he was supposed to watch the ticker tape and only trade after the news is public. I mean, kind of carried to its logical end, extreme, that would imply that he could only trade until after the price had updated to reflect the information. That's going to show up in a later case. We're going to see that sort of construction come out. But then, of course, there's no reason to trade because the price is already updated. Therefore, you can never trade, including when information is public, because you're never quite sure when you've crossed the line from non-public to public. And therefore, nobody will trade, even when they think it might be public. And then you have to really ask yourself whether, in fact, the price will ever update to the level that it should. Yes, Felix?
Doesn't that really only apply to insiders, though? And doesn't that just mean that insiders can't trade when there's an arbitrage benefit when there's a possibility of arbitrage from new information in the market?
Yeah. So Felix points out that before we go too far down the parade of horribles that result from construing non-public in this way, let's just remember that we're talking at the end of the day here about insiders. And we'll talk about what it means to be an insider when we look at Chiarella and we have the misappropriation theory and the classical theory. And at the end of the day, basically, insider trading liability applies to a defined group of folks, people who receive information in some sort of duty of confidence. Of course, the problem is here, if you are even that is circular, right? Because if you are Mr. Gintel, yes, you have received a phone call from a director. But how do you know that the telegram was broken? Because if at the end of the day you receive information from an insider, think about the Tip-E cases you read, you receive information from an insider. If you believe that the information is public, then you should be trading on it. So the problem of when information is public, you don't quite get out of by saying only outsiders should arbitrage, because many people receive information from possible insiders, and then what they're trying to know is, can I in fact trade? Now, this is going to motivate the development of Reg FD, we'll see a little bit later, and the Edgar system, kind of designed to set one point in time. But even there, it's not fully clear what it means to be public. To give you an example from recent scholarship, I have a paper that shows that the SEC was disseminating Edgar filings to a group of people who paid for a subscription to get those filings sooner. Now, the question you might think under Katie Roberts is, if I were a subscriber to that group and I knew that only 40 people or so, maybe I didn't even know that there were 40 people. It's just, you know, I paid for a fast feed of information. Could I trade on that? I mean, where is the line between sort of public announcement and announcement to a group of arbitrageurs? And you might say, well, the key difference is that they're not insiders. I agree, but in the end, you're kind of being fed this information from the firm. So it's not trivial to conclude that the lines here are very easy to draw. It's not trivial to define what non-public means. And Katie Roberts kind of illustrates this. And it's a problem that persists to the present day, because really, conceptually, and this is the point I want you to keep coming back to as we do insider trading law, the moment of publicness is very hard to sort of define, right? That's really the issue. What does it mean for information to be public? You cannot answer that question by saying it means that the price needs to have moved to the equilibrium or true value of the information. You can't say that, because then basically there is never a moment in which anyone will trade on public information. And the fact that there is trading on public information means we need a better story. On Katie Roberts, the court doesn't even really address this. There's a brief discussion of the obligation that Gentile has, but their conclusion is just that he willfully violated Section 17A and 10B and Rule 10b-5, and makes it very clear. The court just sort of assumes that this information is non-public. What is the point that the court makes to tie? How does the court tie Gentile's trading to fraud? What is the analytical link between anti-fraud prohibitions under 10b-5 and trading on the basis of the dividends? There's like a key move that serves as foundation for a lot of this stuff. Did anyone see it? Actually, there's a very particular sentence on page 722 which says that doing something constitutes a violation of the anti-fraud provisions. What is that? What is that? What are you failing to do? Disclosure, right. So the theory that how the court links the trading behavior to disclosure, or lack thereof, well, let me say it differently. The way that the court links trading to anti-fraud liability is through insufficient disclosure. So what the court is doing is saying, look, it's not the fact that you traded on non-public information while as an insider, or just someone in possession of non-public information received that from an insider, but it's that you traded without telling the market what you knew. And this is how we link, in Katie Roberts, trading, which is just buying and selling securities, to a prohibition on fraud. Now notice how big of an analytical step that is. Okay? That's a big step. It's not at all clear why you are defrauding your counterparty when you do not disclose the information that you hold. Can anyone articulate a reason why Gentile arguably was not defrauding the buyers of those securities? Is there just an argument you could make? Yes. Have you? Yes.
Well, I think the court just went that route because they felt that his trading was unfair and they just needed to find a reason, and they found that in the fraud statute. So I would say what he was doing wasn't really fraud. It was he wasn't defrauding the market because By
Why?
trading on that information, the price just reflected the true value of the stock sooner than it would have.
Right, that's true. But why can you articulate a reason, Grace, right?
Yeah.
Grace, can you articulate a reason why you could dispute the claim that it's not fair? Let's just start there. Is there a story whereby do you, Elliot? Right. So if I put in effort, maybe we think, but there's an even more basic reason why fairness isn't as persuasive as it might be. May? Good. So May says it happens all the time. I'm going to sort of recharacterize that as, just sort of reframe that, restate that as maybe Jintel's counterparties expected that they might be trading against someone with information. So this is, remember, a lot of this stuff around what investors expect is very circular. Right? We've dealt with this now in a few settings. You see it again here. So do you, as a potential buyer of Jintel's shares that Jintel is selling, do you assume, do you expect that Jintel might have material, non-public, negative information about the firm? Do you or do you not? I don't know. The point is, nobody knows. That is, at best, an empirical claim as to what shareholders believe. But normatively, you can say, look, the law creates those expectations, right? The law sets the standards. So if, in fact, we don't have a prohibition on insider trading, then everyone in the market will assume that their counterparties might be trading on the basis of inside information. That will be reflected in the price at which they're willing to transact. So if it were the case that Jintel's counterparty, or the market maker with whom Jintel was trading, thought it was possible that Jintel was selling 7,000 shares because of some bad information, that market maker should adjust the price down, thereby taking out any profit that Jintel would make. Does everyone see that? So the real tricky challenge here is that we're kind of arbitrarily assuming that market makers or counterparties aren't making informational inferences to get at this fairness result. This fairness result, this unfairness of taking advantage of your counterparty, turns on an assumption about what counterparties believe and how they price that belief. That is, the prices at which they're willing to transact based on those beliefs. Does everyone see this? Is this clear? So it's not at all trivial to conclude that there's unfairness here. It's not at all apparent. Yes, Elliot's point, there is also effort, okay? But May's really hitting on this, which is maybe, can you really construe a fairness claim when everybody's doing it, and therefore you should expect that? And moreover, price it. Yes, Felix.
Does this imply that there are some insiders that we should be more worried about than others because it's the difference between like systemic insiders and non-systemic insiders? Like an underwriter who has access to a whole slate of I don't know, they can see all this debt's unraveling or something.
Yeah, so Felix says, look, maybe we can make this inference from certain kinds of insiders. If they're selling, we'll learn something about the information they have merely because of who they are. Right, so remember our conversation last week about anonymized markets? So this goes back to our participation discussion. The idea that in a typical transaction with an underwriter, you know who the underwriter is, and so you can make certain informational inferences from the presence of that underwriter. In an anonymous secondary market, you don't have that identity in front of you, and so it becomes a lot trickier to think about how the market will interpret block sales or purchases. Similarly here, if you know who the insider is when they go and attempt to trade, you can in fact probably adjust your pricing a lot more efficiently, a lot quicker, right? If I knew, Felix is the CEO, he's dumping half of his portfolio, or just Felix is a hedge fund manager. All I need to know is something about Felix, and if I see him selling a lot of shares, I'm not going to buy at the price he's selling. But our trading markets, by and large, are anonymous, and disclosure of the identity of actors trading in the market, disclosure of individual trades, does happen for insiders on Form 4, but it happens only 48 hours after those trades take place. So it's not an effective mechanism to facilitate this sort of information-based pricing. Now, that doesn't mean that the order flow in and of itself can't tip off the hand. Remember we talked about how when you see sell, 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 you should think, hey, there's something wrong. Similarly, one question is why it was, in fact, why he was able to execute those trades at that price, right? If the market maker saw that stream of sales, shouldn't he have sell orders? Shouldn't he have thought, that there's got to be some bad news about the firm? So keep this in mind, that it is not at all clear. The fairness story is not at all clear. It depends a lot on what you assume investors know, what you assume investors sort of come into these transactions assuming. We talked already about Texas Gulf, so I'm not going to spend much more time in Texas Gulf. Keep in mind that a similar story is playing out in Texas Gulf when the court says in the page, there's a page missing from the readout, but on the page you have 727, and the court. The Second Circuit says, look, it was the intent of Congress that all members of the investing public should be subject to identical market risks, which market risks includes the risk that one's evaluative capacity may exceed another's. The insiders here were not trading on an equal footing. They alone were in a position to evaluate the probability and magnitude of what seemed from the outset to be a major ore strike. They alone could invest safely, secure in the expectation that the price would rise substantially in the event such a major strike should materialize, but would decline little. If not, such inequities based on unequal access to knowledge should not be shrugged off as inevitable. But again, this assumption that investors, would look out and wouldn't know whether or not there was going to be good or bad news for Texas Gulf, the insiders knew. This assumption implies that prices don't adjust accordingly. Once prices adjust, right, once in fact the price of the firm rises, as it did in Texas Gulf in response to insider buying, it's a lot harder to say that, in fact, the price of TGS stock would rise substantially in the event such a major strike should materialize, because it should have risen already in response to insiders trading on the basis of their information. Okay, so realize that what the courts are trying to do here and kind of micro-founding insider trading liability on an anti-fraud theory. So they're trying to reach into fairness rationales that make certain assumptions about the way prices play out in markets. The key one being that the insiders can trade in a way that has no price impact. That's unrealistic. Often when insiders directionally trade, that is exactly how the price updates and reaches its new equilibrium value. So why does any of this matter? Well, imagine a hypothetical, just think about, again, like, in life or the exam, where you have prices that are already moving in a particular direction. They're already updating in response to insider trading. And the question is, can you really articulate this unfairness rationale? Can you articulate this unfairness rationale? And I think it's important to recognize that a lot of this case law developed on the backdrop of markets that do not update quickly in response to new information. That, by the way, has changed. In the era of high-frequency trading, algorithms are instantly updating prices in response to order flow. And I think you would find it a lot harder as an insider on a day-to-day basis to exploit your informational advantage without moving market prices. And so there's an important institutional detail. Some of this is going to be talked about in the event on Thursday, this changing nature of securities markets. Okay, questions on this? Everyone see this? Yes?
Since the language of 10b speaks about unregistered securities as well,
yeah.
and the insider trading theory specifically hinges on possession of material non-public information.
Use.
Does this mean that insider trading liability does not extend to trades in privately held securities, or?
Good. Good. Great. So the question is, do we have potential insider trading liability? Can we find Abir, right? Abir's question is, can you apply insider trading liability to securities that are what? That are not subject to the 34 Act? The answer is definitely no, right? Because 10b-5 is, by the statute giving rise to 10b-5 is 10b. 10b is the 34 Act, and by its own terms, we read earlier, it's referring to securities. It does refer to securities not so registered on a national securities exchange, but by the definition of security, we are talking only about those securities to whom the 34 Act applies, right? So you cannot bring a claim based on the 34 Act for securities which are not swept in under the 34 Act, okay, to 10b. Now, that is going to be a pretty limited category, right? So if you think about most restricted securities that trade on private placement markets, like employees who are given shares or private placements, these by and large will all be swept into the 1934 Act. I suppose it's possible I won't do this now, but you could let's see. Well, maybe I will. It's going to be hard to think of a security that would not be covered by the general anti-fraud prohibitions of the 34 Act. But just to complete this, let's look actually for how term security is defined when used in this title. The term security means any note stock, treasury stock. It's pretty much everything, right? So it would be. You might be able to, so purely intrastate transactions to where you'd have a constitutional objection to the application of the 34 Act, maybe. So it'd be difficult, but it would be possible, but difficult. Yeah.
I also had a question about the price phenomenon you spoke about, that when insiders trade, there'd necessarily be some price fluctuations. Going back to Texas Gulf, the standard of materiality there, the court outlines as the probability magnitude test.
Yep.
But that seems to conflict with the fraud on the market theory underpinning the reliance causation element, because isn't there a presumption that prices reflect, when the disclosure is made, parties use statistical techniques to show whether the prices have indeed changed in response to that statement?
Yep.
So doesn't that undercut the matrix basic line of decisions?
Doesn't what undercut? So can you?
Does the reliance causation element basically collapse materiality into? Does it basically, the probability magnitude is defunct because of the way reliance causation is proved?
So in fraud on the market, you have. So let me make sure we're talking about the same thing. So in 10b-5 here, we're talking about trading in connection with is the sort of reliance element of our current conversation. We haven't done fraud on the market yet, but here we're talking about trading that was in connection. Fraud that was in connection with the purchase or sale of a security. So in this setting, okay, we saw in the readings that it's sufficient to establish that there was materiality and public disclosure of the information to satisfy the in connection with requirement. We haven't done this formally yet, but that's the idea here. You're right that the price change in the case of a fraud on the market setting where the firm is not disclosing, the price change does provide information. So maybe I'll try to relate these two ideas. So here you have insiders who are trading, and prices are changing in response to their trading. Fraud on the market, you have either a misstatement or an omission by the company. Sort of by definition, you don't have trading on the information because I think this is your point, the price has to change in a fraud on the market case, right? I think this is what you're saying. Yeah. So, okay, great. So in the fraud, let's just make sure this is clear. In a fraud on the market setting, which we haven't gotten to, but just so you, as a preview, you're going to be looking for a change in the price upon the public announcement of a fact that wasn't known to the market. And your point is, Abir's point is, look, that relies on the assumption that the price changes, meaning that there wasn't trading on the information prior to that announcement. Because if there were to have been trading on that information, the price would have moved prior to the announcement, and thus it wouldn't have changed at all when there was an announcement. And that's right, and that's why these are two different settings, right? So in the 10b-5 insider trading setting, what we're looking at is trading activity that is often moving market prices, and the claim is not that the company was silent when it should have said something or said something misleading to the market. The claim, the company was just fine. The company made its announcement whenever it was going to make its announcement, but some bad insiders were trading on the future announcement. Do you see the difference? So the insiders who are trading on the future announcement could very well move the price. In a case where there was never a fraud on the market question to begin with, there's no fraud on the market. All that's happening is that the value of the firm is sort of being impounded earlier than the announcement because of the insider trading. And then the question is that unfair? And the answer to whether that's unfair turns on what you assume about how prices update and whether or not insiders are actually able to get this unequal access to knowledge where they can truly exploit their knowledge of a future event prior to it having been announced. But fraud on the market involves settings where the disclosure by the company is either insufficient or misleading in some way. Here, we're going to assume that the company's disclosure is perfectly fine, that there's really nothing wrong with the final announcement, and we're going to focus on trading behavior by individuals prior to that announcement. Is this, you're not 100%, or you do agree? After, okay, we'll continue after. As everyone sees the distinction here? So the assumption here is that the announcement is truthful. We know what the firm is worth upon the announcement, and yeah, these two can go hand. I don't want to say that they can't go hand in hand, but I want you to see analytically here the unfairness. I think this is your point. Turns on the assumption that the price doesn't change. All right, and that's a pretty big assumption. Okay. All right. Investors management has a lot of facts, so I think we'll save those for next time. Read that. Read SEC v. Adler, and just look. Let's see. Yeah. So tomorrow we will go through the remaining. Let me just get the syllabus up here. So for tomorrow, those of you who like to know what to focus on, you should read. Let's see, Investors Management, SEC v. Adler, we'll do Chiarella, and we'll do the sort of really the nuts and bolts of the development of insider trading law, the classical and misappropriation theories. Yeah, okay, that's tomorrow. Don't forget office hours tomorrow afternoon. See you then.